pronounce your... Oh, wait a minute.
You're not in Italy.
No, not in Italy. Yeah, I realize now I'm not in Italy. I haven't yet mastered Luxembourgish. So, and from, starting on time and all the rest of it, so to speak, I said, I thought I was in Italy.
Please
Anyway.
speak on the microphone.
Yeah?
Good.
Is it on? Yep. Thank you. So, thank you, Ed, for all the praises. And actually, I could already leave before my talk. But anyway, since I'm here, I'm going to talk about volatility derivatives. And as Ed said, after the financial crisis, or with the financial crisis, we got all this bad rap about derivatives from prominent people, including as I remember, the Minister of Finance of Italy, who said that derivatives should be banned. But as far as a person that we all have a lot of respect for, like Warren Buffett, except that Warren Buffett himself sold a bunch of derivatives to a lot of financial institutions. He still said that it's like weapons of mass destruction. Well, I'm going to try and convince you it's not. And actually, the financial crisis that Ed mentioned was a time where not just derivatives, but especially volatility derivatives are an instrument that would be very helpful to institutions that have been, let's say, under pressure and exposed to the risks. And it's a great hedging tool beyond or in addition to all the other derivatives that we are familiar with. So let me go on and just show you what the outline is. I'm not going to go through it one by one, except I'm going to say that my talk is going to be a combination, if you want, a mix of some academic stuff, practitioner, if you want, experience, and I'm also, of course, going to try and talk a little bit about the history, which really relates to what Danny, my colleague here, who spoke in the morning, and we have an intimate relationship with the volatility measure called VIX. So let me give you a little bit of a background. I think it's always important to get a more general perspective and numbers that Ed already mentioned. Before 1970, the world of derivatives was actually all concentrated basically in the United States, and it was agricultural commodities and metals. And I'm not going to get into the details of why were the derivatives on these and not on others, and why in post-1970 we get all these financial derivatives. The key is, of course, volatility. I mean, you'll have a demand for an instrument, a derivative instrument, if there is a reason you need it, not for speculation. For speculation, you create casinos. But if you need it for hedging, you're going to get derivatives. If there's no volatility, there's no need for derivatives. And the classic, of course, examples are the foreign exchange market, which was, before the 70s, basically fixed by all the countries, the governments. Or, for example, the debt market wasn't fixed, but there was almost no volatility in the debt market. actually would say, why not the equities market? Guys, the equities market was relatively small compared to, for example, the debt market and the foreign exchange market. So there was not much interest. 1970s changed all of it. Now, let's talk a little bit about the size of the market, the global size. So exchange traded between 60, 70 trillion notional, equities 20 to 30. And by the way, I thought of a curiosity that in the Korean market, the derivatives market is 100% or over 100% of the spot. And people tell me that is mainly coming not from institutions, but from individuals who like, in that case, who like to speculate, who like to gamble, and they do it in the derivatives market. The overall over-the-counter, and Danny mentioned it in the morning, more or less, we have 700 trillion in notional in derivatives. If I break down the OTC derivative markets, then of course the big market has always been the interest rate derivatives market. And in fact, one of my criticisms, and I wrote an article in Forbes on it, with the Dodd-Frank legislation, I said, okay, yeah, the CDS market was a problematic market, and you had all this new regulation and legislation. The one market you shouldn't touch, which operated well, perfectly, even during the crisis, was this market, which is interest rate derivatives. But of course, what is happening, you know, and it's happening in the States, in Europe, the regulators decided to control all the markets, including the interest rate derivatives market. And you get the breakdown of the others. You just should look at the global spot market. This is more or less the size of the global spot market, and you see relative to the global spot market how large the derivatives market is. Now, here I have to dwell into the history. I'm not going to spend too much time doing that, but I think it also gives us, you know, some lessons to learn. You wonder, you know, it so happened that in 1973 we started trading options on the CBOE, and coincidentally the Black-Scholes-Merton model came about. And I'm kind of emphasizing that because when we come to volatility derivative, which I'll talk about later on, you'll see that there is something which is important, and that is what is called benchmarking. You need some kind of a model that will tell you, will give you an idea to benchmark. Market makers will not make a market in a new instrument unless they have a clue how to quote prices. And in that respect, the Black-Scholes model came about at the right time, and the market was built up. Implied volatility, which is something that, you know, every hedger that needs to know about as part of any position that you have, was derived then, and in fact, what we're going to talk about later is just implied volatility generalized. So index options start trading priced by the Black-Scholes model from the beginning, and here is an interesting observation. Ed mentioned some of my engagement with the experience on. I spent time, I took a small sabbatical or leave from the university, and I was a trader on the floor, and that in those days on the floor of the exchange trading options. And we traded options then not by price but by implied volatility, which means that we priced all the options, all the strike, at the same implied volatility. So if you wanted to quote a market, you didn't come and you say, how is the 50 January call option? You said, what's the implied? And the answer would be 17 bid at 18, which means I'll buy it on 17 implied volatility, I'll sell it, and then you price it. You put on the prices according to that implied, any option you want. Well, why did we do that? Well, it was a shorthand rather than pricing every strike price and every maturity, but this was assuming, actually, if you want, that the Black-Scholes model perfectly works. When we realized between 1983 and 1987, we realized that the market doesn't think that way. The market does not price all strikes and maturities the same way, and we stopped quoting by implied volatility. In between comes 1986, my dear friend and colleague who actually wrote the first empirical dissertation on options, and he also was commissioned by the CBOE to do what's called an options index. Out of that and discussion with him came about our idea of constructing a volatility index, which ended up being, the CBOE did it, being the VIX, but we had it in writing, so to speak. So we had a paper published, not in a top journal, but in a journal which was popular enough in the US at least. We published our first paper on basically the volatility index and derivatives on volatility.
Menachem, let me amend that comment. You said not a top journal, but you know it has 150,000 readers. How many academic journals have anything close to that? The financial analyst journal I'm talking about. You're right. It doesn't get you tenure and promotion, but it certainly gets you readership.
Thank you, Ed. Okay, just keep listening, so maybe you'll make some more comments like that.
I'm just trying to improve your vita.
Okay. Anyway, as far as the derivatives or the options market is concerned, 1987, well, there are a lot of things that happened following 1987, whether it's portfolio insurance and so on, which I'm not going to get into. But as far as option pricing is concerned, 1980, the crash was a turnaround. We started pricing options on what is called the skew. And whoever is into options really and trades in these markets, of course, in the middle of the night, blindly, whatever, you say the skew, you don't have to say anything else but the skew. We all mean the same thing. Not only that, the skew became a worldwide phenomenon. Basically, the skew is, for those who are not familiar with that much, the skew prices put options which are down there, out of the money, expensively. I say it in very simple words. They are priced relatively higher than what we call the at-the-money options. And it, of course, you can give it several explanations. One of them has to do with hedging against disasters. So you're willing to pay up for these put options down there that are going to give you a floor in case of a disaster. And it has been there since then. And this is in the equities market, by the way. Of course, this contradicts the Black-Scholes-Merton assumptions. We suggested some other models like the CV, the constant elasticity of variance model, but I'm not going to get into why it's not as widely used. By the way, as a matter of fact, as much as these empirical studies have shown that the Black-Scholes-Merton model doesn't exactly holds, that there are issues, that the assumptions are too strong. From the surveys that are being done every couple of years, where institutions that use options are asked about the pricing, market makers that asked, I would say over 90%. In the equities market especially, and also in the foreign exchange market, use as a benchmark, as their first benchmark, the Black-Scholes model, to give you an idea of pricing. They may then deviate and do adjustments, but the Black-Scholes model is thriving and alive. Now, let me get to volatility derivatives. Volatility, again, I said volatility. In this case, the demand for volatility derivatives is because we realized that volatility itself, unlike in the Black-Scholes model, is not a constant. That volatility itself is volatile. And sometimes it is very volatile. And the volatility of volatility is disrupting all kind of portfolios, positions, and so on. And there was a demand for volatility derivatives. So at the beginning, we had over-the-counter variance swaps, which were then discussed already in those days. Now, I'm going to go over this very quickly. Danny and I were trying to sell the idea to some exchanges, to the American exchange, to the CBOE, to all kind of exchanges. And as I said, and this is from my practical side, it was before its time, and you come to an exchange and you talk to the market makers, and the market makers say, first of all, they said it's too complicated. Who's going to use it? And then they said, how are we going to make a market? What are we going to do? We don't have no clue. You cannot use Black-Scholes for that. How are we going to make a market? If we cannot make a market, we're not going to introduce it. And that's why it has taken a long time, by the way, even for the CBOE, who launched the index. In 1993, they launched the VIX, the known VIX, and it took 10 years, no derivatives, just an index. It took 10 years to change the methodology, and even then, it took another few years, it took another year to introduce futures, and another couple of years to introduce the options. And I'm going to talk about it as what can we learn from that, of course. So, in 2004, they introduced futures on VIX. No market. The average volume was between 1,500 and 2,000 contracts a day, which is close to nothing. Okay? It wasn't used as a hedging tool, definitely. In 2006, they introduced options. I'm going to come back to this. And as soon as the options are introduced, the market booms. The options come in the first few days. There are 100,000 contracts a day. But not only that, the futures contracts have started trading in thousands of contracts. And of course, I'll talk about the reason for that in a minute. Not to just talk about the US markets, I want to mention that VSTOXX, which is the volatility index of European companies, was introduced in 2005, and in 2012, just recently, the Nikkei volatility index was introduced. Now here are the numbers. And look, this was a period of large volumes, more than even recently. Recently it declined somewhat. You can see in April 15, 2013, 450,000 futures, and I'll show you the chart next. nowadays we have volatility indices on whatever you want, whether it's currencies, whether it's oil, and so on, and I'll show you some chart as we go along. Here's the example in October 15, the options were trading 1,800,000 contracts a day. It's one of the biggest markets in the world in derivatives, options and futures. Now, let me say a few words now. I have to say a few more academic words about the methodology. Actually, there are two methodologies going around, not just the new one that was introduced by Emanuel Derman, but there is the previous methodology which was amended. One thing they have in common, and when we introduced it at the beginning, we thought it's a very important principle, is that you keep the number of days. If you look at the VIX, and the immediate or one interpretation of VIX is the expected volatility, forward-looking volatility, then you need to have a fixed number. You cannot have an index that the number of days changes every day, because if you just use an implied volatility today it's 20 days, tomorrow the same option has 19 days, then 18 days, and so on. So the principle should be, so it's comparable, that I have a volatility index today, and it's derived from options, right? So it always has 30 days. It's 30 days today, and tomorrow, and in a week from today. In order to get that, in order to achieve the same number of days, you could do 30 or 60 or 90, whatever it is. This was determined in 30. Then you need to combine options with different strike prices. A short one and a longer one, which is longer than 30 days, and do a weighted average, some weighted average that will always give you 30 days. Of course, the weights will change as you go along. And that was a principle that was kept whatever methodology is used. Now, specifically, in terms of what do we use? Do we take the options and have an implied volatility first, or do we take the prices? This was a debate still going on, but the methodology that is used by, and I'll go to it first, this is the VIX methodology, which is different than what was before, and it's different what Danny and I proposed. It's not supposedly, I don't want to say supposedly, but it is grounded in theory, call it in consistent theory. The one problem, of course, is with academic stuff is that it could be grounded in good theory, but when you come to implement it practically, it doesn't do the job you expect it to do. And what is good for the US market in terms of the options traded and the liquidity in options that traded, this is a good methodology. But if you come to markets which the options traded are less liquid, then that may be a misleading methodology. And that's why we are proposing a somewhat different methodology. I don't want to get into the details of that, but basically this is the methodology where you use, by the way, they use prices here, not implied volatilities, but they use prices, and it ends up being essentially an implied volatility number. Now, the methodology that Danny and I are using also uses prices, and we create what's called a synthetic 30-day price of an option. But then at the end, the final stage is that we turn it into an implied volatility by, at that point only, using the Black-Scholes model. But I just want to tell you why this methodology is, at least in the United States, works well. And this is a case where theory and practice end up being fine and it works well, is because if you use this methodology and you use a methodology that we basically propose, you get a correlation of 0.98 between these two serious numbers. If you go to the markets which are not as liquid, you'll get a bigger discrepancy between this methodology and the other methodology. So you have to know what is the proper way or where to implement a certain methodology. Let me show you some interesting, this is which I make sure to update every time I give a talk like this, and I just updated it a couple of weeks ago. And my dear friend Ed, he likes to make some predictions when he gives his talks, and I don't like to do that usually. But if you look at the current period where we have really low volatilities, if you look there at the end, it looks very similar in some sense to the period before the financial crisis. See, this spike here to 80% VIX, that's of course September of 2008, that's where it jumped. Look at the period before. The period before we had in 2006, we had almost the lowest volatility ever. I mean going back like 30 years or so, or more than 30 years. And recently we have the same thing. So there is an interesting view here, because when we were in 2005, 2006, and so on, people were talking about that we are in a new era. I remember when Ed and I were meeting some journalists and we're talking about then, yeah, it's all quiet. Quiet on the Western Front or wherever you want, on the whole front and so on. And then we got the financial crisis. Now it's not the same, because when you talk to a lot of policymakers and people, they are concerned. But when you look at the measurement and you look at the markets, it looks kind of low volatility as one indicator. It's not the only indicator. Let me just go on, and here is something, just a particular thing which may interest people who trade in these derivatives, is when there is an event and volatility spikes up, it has been the case in the past. So, something like the Greek crisis. So there was a spike, but once there is a spike in volatility, it doesn't come down very quickly. It takes a while for it, and people were taking that into account in pricing options and so on. Well, recently, somehow, the market has changed, and I'm showing you that as an example. In a short period of time, we go from 14 or 15% to almost 30%, but as well, we go down in a short period of time from 30% back there. And that's a new phenomenon. It's of interest. You have to watch these markets, and they keep changing. So this is a new phenomenon, a relatively new phenomenon that we like to take into account. Now, I cannot talk about this without mentioning the Volatility Lab, which is our Nobel Prize winner. It was mentioned here before. Rob Engel, who is running this Volatility Lab, and they use the statistical method, which is called GORGE, which is real or realized volatility, really. Is not from option pricing, but it's interesting to see how similar you see the changes in volatility, while the red is the realized using the GORGE methodology, because GORGE, basically what GORGE is uses past changes in prices and giving those past changes different weights, where typically it will be that the more recent data will have a higher weight. So that is in the red line. The VIX, the implied volatility, this is derived from options, is, as you can see, consistently higher than that. And this is something we call, the concept we call the volatility risk premium. There is, like, on the average, a difference of 1.5% to 2% on an annual basis between the VIX, or the options volatility derived from options, and a realized volatility. And there are several explanations to it. One of the explanations to it is, of course, that realized volatility measures the changes that you have in prices or in returns. VIX is forward-looking based on option prices. So when people buy options, they take into account, for example, the probability that there could be a jump, and they will pay a little bit more if I think there could be a jump. There's volatility of volatility and other things. This will not, I mean, the jump may happen, maybe in a month, maybe in a year. It's not going to be reflected in the realized volatility, but it will be reflected in the options price. So that's why you basically have this discrepancy. It's interesting, I just got from actually a student of mine that works for Deutsche Bank that they have some model theory that this volatility risk premium is actually, they use it as a predictor of future returns. I usually have my doubts about these things, but that's something that they claim to have found. Very quickly, I have three markets here: the VIX, the US VIX, the VIX on the European quoted VIX, and just as a sample, I picked from the East. So I picked the Hong Kong VIX. Consistently, VIX is lower than the other two. I just got my dear friend Ed, no mercy. 10 minutes, he says to me, so I have to go to where I think I want to say a few more things which could be interesting. So, I'm an academic, or at least one of my hats. So, VIX research, what is being done in terms of research? Well, basically I broke it down into three areas. Some people use VIX nowadays as a measure of a proxy of the forward-looking volatility, as we say, and how that one is related to what is happening in the markets and what is happening in the real economy. So there are more and more so-called pure economists, not guys in finance, who started using VIX in their research. Then there is, of course, a statistical analysis that compares VIX to realized volatility, what I just mentioned, the volatility risk premium, and so on. And, of course, when we talk about volatility derivatives, is the same thing I'm going to talk about next, is how do we price instruments on futures and options on volatility. So this is what I'm going to get to now, and here are two basic observations. Volatility is not approximately constant. Volatility is stochastic. It is sometimes very volatile. You can have 1 week where it's slow, and the next week volatility itself jumps around. Volatility risk can cause disastrous losses, and if any of you remember or had a chance to read the book on LTCM that was written by a New York Times reporter who spoke to the partners in LTCM, there is a whole chapter on them engaged in this market, in this volatility market, and it wouldn't have saved them, but if they could have then used volatility derivatives to hedge their volatility positions, the losses would have been somewhat or significantly lower than they were. Of course, their basic loss was this, the Russian bonds and shorting the American bonds and so on, but they had a whole position in volatility. Now, what is the objective? Hedging volatility risk, volatility of volatility. You can always do in options a dynamic strategy where you use the instruments to hedge yourself. But dynamic strategies, usually, one, you don't know what the cost is a priori, and two, it usually has high transaction costs. A static strategy would use derivatives, but those only came about with, I'm not going to talk about that, let me talk here about this. So, what are the observations since the market started in 2004 with futures and in 2006 with options? As you can see, options are among the 3 most active index options. Of course, the call volume is much larger than the put volume for a very simple reason. So the volatility is at 13. Then what demand is there going to be for puts on volatility? How much further how low further can the volatility go? So another percent or two, not, but it can spike up. So that's, of course, a natural thing.
You said it's stochastic.
Yeah, what?
I thought you said it's stochastic.
Oh yeah, it is stochastic, but it depends. It will go down and it will go up. But how much up and down can it go? And of course, it depends where you are. I mean, if you're at 30% volatility, it can go down to 10. But if you are at the 10% volatility, it cannot go down to 0. Right? Anyway, futures and options and VIX, big volumes, big open interest. But here is an interesting phenomenon. And I haven't seen yet a paper trying to explain that. Usually we say, if you have huge liquidity, then the bid-ask spread should be small. The big liquidity is associated. Here is a market where the bid-ask spread, in all kind of comparisons that you do, adjust it for whatever you want, is huge, and liquidity is big. So, or volume is big. How do you explain that? And one of the explanations is, and people haven't yet done research on it, but it's a good topic, is there is very big disagreement about what this is back to my first comment about a benchmark model. There is no benchmark model agreed upon of pricing options and futures on volatility. I've talked to several market makers that make markets in these. First of all, they don't tell you how they price it, and two, there is no agreement to start with some kind of a consensus or a benchmark model on it, and that may explain this discrepancy. But, and let me say now the other thing. Why did the futures market start trading in huge volumes when you introduced options? Because here are two instruments which are intimately related. When you had the futures market by itself in 2004, you wanted to make a market, what would you hedge with? You had nothing to hedge with. Once the options were introduced, the market makers and options could hedge with the futures and vice versa. And that's where the futures market has boomed and is a huge market right now. So you really need, and we were talking to some exchanges about exchanges that don't have yet volatility derivatives. We told them, hey guys, you want to introduce volatility derivatives? You have to introduce both instruments at the same time. Don't start like traditionally used to be. We start with the futures, we see how it works, we introduce options. No way. You start with the futures, you're not going to get a market until you introduce the options. So if you want to introduce these instruments, you have to introduce them simultaneously. Okay, good. So the main problem is, of course, this is now the academic question, which is also a practical question. Pricing by no arbitrage. VIX is not traded. VIX is an index. So you cannot do the classical, whether it's futures, where we have what's called the cost of carry model for gold, for FX, for all the financial instruments. Here, there is no underlying. The same is true for options. There is no arbitrage-based model. But, so how are the options priced? What are they priced off? Well, it turns out that the options are priced off the futures contract. If you look at the futures contract, that's the underlying. And in fact, we looked at put-call parity. Does put-call parity hold? Yes, it does. Vis-a-vis the futures contract, it settles with VIX, with the index. But hey guys, at the end, on expiration, the futures becomes the index, and so do the options. So if you price it off the futures, then you can survive. I'll just say a few words. I don't want to get into it. This is a relatively small market, like the VIX market, where we have an implied correlation market. And in fact, the more interesting, because somebody just sent me last week a paper from the Bank of England that talks exactly about that. And this is not new. This is very, I would say even old, but hasn't been used. And the Bank of England has recently started looking at these numbers. Now, this is intriguing simply because you really can compute a precise implied. You cannot do an implied correlation on stocks, but you can do an exact implied correlation, especially with the so-called the big currencies, because of the triangular relationship. You have three currencies, there is a triangular relationship. It doesn't deviate from there. If you use the triangular relationship, you get this here, is the pointer working? The correlation 2 to 3 is all on the right-hand side. It's all volatilities. So all you need to do is to get the options, for example, on the euro, on the yen, on the dollar. You get the options, you measure the implied volatility, you insert them, you get your correlation, your implied correlation. So you can measure an implied correlation, and here, for example, how it looked like what we did this measurement between 2000 and 2013, the implied correlation, of course, moving around, and as I said, this is one of the inputs that the Bank of England is using when they're making their interest rate decisions. They use implied volatilities and they use implied correlations. So that's, yeah. So just to conclude, the volatility derivatives market has become a huge market. For now, in the US, there are futures and options in Europe on V stocks. So far, the volume is moderate, but it's picking up. And now we have the markets in Japan, and China has just introduced options, and Hong Kong, and volatility derivatives are going to come about. And more people or institutions are realizing it's a more sophisticated instrument, but they're realizing that it should be part of their arsenal or of what they have as tools to deal or to hedge not just volatility, but volatility of volatility. It makes the whole thing much richer, and as I said at the beginning, it would have been helpful in the financial crisis. So, thank you very much. And